Welcome back to The Explainer. Okay, picture this for a second. You're 24 years old, a former AI researcher, you get fired, decide to start your own fund, and somehow you turn $250 million into $14 billion in less than 2 years. I mean, it sounds completely made up, right? But that is the actual real-life story of prodigy investor Leopold Aschenbrenner. Up until recently, he was known as the most famous AI bull on Wall Street, just totally riding that massive wave of semiconductor success. But his latest portfolio filing reveals a complete reversal that has absolutely everyone talking. He is essentially called the top on the current AI chip market. So today, we're going to use the data and his actual filings to break down exactly what this means, specifically for your portfolio. To really wrap our heads around the scale of what we're looking at today, we just need to look at this number, $8 billion. That is the massive short position Aschenbrenner just took against the absolute biggest names in the AI market. Just to put that into perspective, that represents 40 times more than his entire fund was worth just 18 months ago. It's an incredibly aggressive swing against the very companies that basically built his current fortune. So here's our roadmap for this explainer. We'll be hitting the $8 billion short, demystifying the trade, the battle of chips versus electrons, hedge fund versus retail strategies, and we'll wrap it all up with a durable AI thesis.
All right, diving right into Section 1, the $8 billion short targeting AI giants.
Look at the names targeted by this short. These are literally the undisputed darlings of the AI revolution. Right at the very top, Nvidia. He's sitting on a $1.5 billion put position, plus some heavy short exposure through the SMH semiconductor ETF. So you combine those and you're looking at a staggering $1.9 billion bet against the market's ultimate poster child. And it doesn't stop there. He's also shorting AMD, which is wild, considering he's doing it right after they saw a 74% gain in a single month. He's betting against Broadcom, the folks literally building OpenAI's Project Stargate. He's even shorting ASML, which has an absolute 100% monopoly on chip lithography, and Intel, a company that previously made him billions. It honestly looks like a total sweeping rejection of the entire semiconductor supply chain.
Moving on to Section 2, demystifying the trade and understanding the strategy.
Now, before you panic, the reality behind these terrifying headlines is that Aschenbrenner is likely just executing what's called a collar trade. Basically, he is trading a bidirectional book. This means he's matching a bunch of his short put positions with long call positions on the same, or at least related, companies. He's hedging against uncertainty. If he thinks the chip design trade is just currently overcrowded and overvalued in the short term, well, he can earn massive premiums from the margins between these positions, totally regardless of which way the stock price actually moves. So this isn't necessarily him predicting some apocalyptic crash, right? It's really just a highly strategic, flat trade to manage massive amounts of capital in a very crowded market.
And here's a super crucial point. We've got to remember what data source we are actually looking at. This is a 13F filing. It is essentially just a delayed snapshot in time, capturing trades from January 1st to March 31st. Aschenbrenner is running a highly nimble hedge fund, okay? Not a venture capital fund. He uses leveraged bets. He pays high premiums. Honestly, by the time you and I are sitting here analyzing this data, he could have already completely altered or exited these short-term trades.
Which brings us to Section 3, chips versus electrons, or the new bottleneck.
This is where we get into a genuinely brilliant core thesis. We are moving from the old bottleneck, which was the chips themselves, to this new bottleneck of electrons and memory. You know, the design space for semiconductors is just insanely overcrowded right now. Valuations are currently pricing in this perfect world where every single chip company wins equally. And let's be real, that just isn't reality. The money is flowing downstream. You can have all the fancy GPUs in the world, but if you don't have the licenses, the permits, and the access to the existing energy grid infrastructure to actually plug them in, they're basically useless. The new bottleneck is physical power generation, the real estate for massive data centers, and the NAND flash memory required to store temporary data for these massive AI models.
Actually, think of it this way. AI is like a car. For the past couple of years, everyone, and I mean everyone, has been obsessing over the engine, the chips. But honestly, a world-class engine does absolutely nothing if you don't have fuel. AI ingests energy, processes it through massive physical infrastructure, and outputs data, kind of like exhaust fumes. We really have to look past the engine now and focus on securing the fuel.
So where exactly is he building his long portfolio? He is doubling down on physical infrastructure winners. He's maintained these massive positions in neoclouds like CoreWeave, which are out there signing multi-billion-dollar deals to provide GPU access. He holds over $1 billion in Bloom Energy. They make portable gas turbines you can literally just drop next to a data center to generate power completely off the grid. He's heavily invested in SanDisk for their temporary NAND flash memory. And what's really genius about this is that he's playing both sides. Even if the chip designers lose value, companies like CoreWeave still win because they possess the ultimate prize, the power access and the licenses.
30 gigawatts. Just let that number sink in for a second. That is the approximate interconnected power capacity that US Bitcoin miners are bringing online this year alone. To put that into perspective, that roughly equals the total data center power announcements of Microsoft, Google, Amazon, and Meta combined. No joke. Bitcoin miners already have the absolute hardest part figured out: the power, the permits, and the infrastructure. All they have to do is swap out their crypto rigs for AI chips, and boom, they are instantly dominating the new bottleneck.
Okay, Section 4. Hedge fund versus retail and why our goals are so different.
It is so absolutely vital to understand that AI investing, it's not a one-to-one game between massive institutions and everyday retail investors. Hedge funds use totally different short-term tactics. They're making highly leveraged bets, skimming profit from premium margins, and shifting their massive portfolios every single quarter just to balance their books. Your goals as a retail investor are entirely different. You are looking for durable, long-term growth. You're aiming to hold through market volatility without paying the kind of exorbitant transaction fees and premiums that a billion-dollar fund can just casually absorb.
Because of those stark differences, literally the worst thing you can do as a retail investor is just blindly mirror some aggressive institutional short position. If a retail investor tries to swing trade against Nvidia or Broadcom based on a delayed 3-month-old headline, they risk getting completely wiped out. You and I simply don't have the billion-dollar capital buffer or the bidirectional hedges to protect ourselves if the market decides to just run up another 20% out of nowhere.
All right, finally, Section 5, the durable AI thesis in navigating the shift.
Now, if you're sitting there worried that Aschenbrenner's move signals that the AI bubble is popping tomorrow, take a breath. Prediction markets are telling a very different story right now. According to Polymarket data, there's only a 24% chance that the AI bubble bursts by the end of this year. Furthermore, there's a massive 93% probability that Nvidia remains the top company in the world by the end of May. So the broader market sentiment simply does not reflect the aggressive, short-term volatility implied by hedge funds options trading.
Plus, we really have to acknowledge the elephant in the room, where this massive short trade could fundamentally break down. Nvidia's moat might just be way stickier than Aschenbrenner is betting. I mean, they command roughly 80% margins on their GPUs, and the demand is relentless. We are literally seeing 6 to 8-year-old Nvidia chips being rented out a year in advance for more money today than they were worth 2 years ago. Add to that their CUDA software platform, which heavily locks developers into their ecosystem. Betting against that level of dominance is a massive risk.
So what's the game plan? Here is a clear, level-headed framework for retail investors navigating this shift. Step 1, avoid panic selling your long-term holdings based on delayed, highly complex hedge fund headlines. Step 2, recognize that while AI is absolutely real, the specific trade of just buying chip designers is getting really crowded. And Step 3, start researching the downstream beneficiaries. Look into the durable physical infrastructure, the companies that actually control the energy grids, the physical data center real estate, and that crucial memory storage.
As we wrap up this explainer, I want to leave you with one vital question to kind of chew on as you evaluate your own holdings. Does your long-term portfolio actually reflect the physical infrastructure, the massive power generation, and the memory needed to fuel the future of AI? Or are you just chasing the latest overcrowded chip stock? The frontier AI is moving away from the digital blueprint and straight into the physical world, and honestly, that is exactly where the next durable investments are going to be found. Thanks so much for joining me on this deep dive, and I will see you in the next explainer.